Let's talk about sell and buy real property and defer taxes with Section 1031 exchange. 1031 exchange, also called line kind exchange. Line kind exchange meaning that you sell one real estate property and in exchange for another real estate property within a required time. So let's talk about that. A lot of people have questioned recently because this real estate market is really hot and people selling houses and buying houses and worry about paying taxes. So when you sell a real estate property, what happens? You either will have gain or loss. So when you have gain and you pay tax, and when you have a loss, and then the loss can offset capital gain and not necessarily offset all your other incomes, it can only offset capital gain. So let's talk about that. When you have capital gain, that's subject to capital gain tax. So capital gain tax rate is from 0% to 20%. It really depends on your total taxable income. So if your total taxable income is roughly 440,000 or less, and the capital gain tax rate is 0. So if you, as a single person, I'm talking about as a single person. So if you're head of a household or a married filing joint, that the threshold could be higher. So if you are a single person and you make 440,000 more roughly, then the capital gain tax rate could be 20%. But that is the ceiling. So 20% and not going to go up to other higher percentage. However, if the real property you used to use it as a rental property, so as a rental property you took depreciation, probably regular depreciation or bonus depreciation. In this case, when you sell this property, the gain portion of this gain is a recapture of depreciation, meaning that the depreciation you took before, it will be treated as non-capital gain, meaning as a ordinary gain, it will be taxed with all other income except for capital gain. So the tax rate could be different, could be higher. So it can, but it cap on 25% if it is regular depreciation. However, if it's excess depreciation, meaning that you did not use a straight line, you use bonus depreciation, you expedite the deduction, then now when you sell the property, then you have to pay a higher percentage of that gain, the gain related to the depreciation. For losses, when you sell a property, you have capital loss. What are you going to do? If you don't have capital gain to offset that, you can only deduct $3,000 per year. If you have capital gain from other sales, great, then you can offset that. Any unused loss will be carried forward forever until you use up of it. So now is 1031 exchange kick in. A lot of people sell a property and they do not want to pay the tax right now, and they do want to continue invest into real estate property and grow their business. In that case, they can do a 1031 exchange. So how is 1031 exchange work? The general requirement timelines is 45-day rule, 180-day rule, and how does that work? You sold the property, you close the deal, and then within 45 days, you need to find 3 property that identify 3 of them you're gonna use as a replacement property. So within 180 days, one of this property need to be closed. So meaning that you purchase that property with the fund you got from the property you sold. So basically, if you are thinking to do a 1031 exchange, make sure you let your representative know at the beginning. So the process is a little different in escrow. When you are doing a 1031 exchange, basically you cannot touch the cash because the cash is going to put into a trust account. And then once you identify the new property, the replacement property, the funding will come out from the trust account and pay to the seller of the replacement property. So you cannot touch the cash. It is 1031 exchange. It's basically a tax deferral planning used by a lot of real estate investors. So the purpose of that, the benefit of that is that you're cashing out from the property. You get the money, get the gain, recognize the gain, but you don't. But yet you defer the capital gain tax, and at the same time you can continue to grow. So when we say cashing out right here, we got to be careful. So when you do a 1031 exchange, you're not supposed to touch the cash, meaning the cash is not supposed to pay to you, it's supposed to pay to the new property. So what happens if you touch the cash? How are you going to report that? So the 1031 exchange, line kind exchange, reported on 8824. We're going to talk about it and have a very simple example to show everybody how to fill out this form. Let's give an example. Let's say you sell a property for $500,000 and carrying a debt of $300,000 and come up with a gain. Let's assume that the basis, the cost of the property was $300,000. So you have a gain of $200,000. And then you take this $500,000 and put into a new property, buy a new property within 180 days, identify it within 45 days, and this property is much higher than the old property you bought. You put in that case, you either acquire another loan, $200,000 loan, or you put in another $200,000 cash to buy this property. In this case, the whole $200,000 gain from selling of this first property, it can be deferred, meaning you don't have to pay tax this year. Partial 1031 exchange. Remember we talked about you cannot take the cash out. Let's say you sold the house for $500,000 with a $300,000 loan and $200,000 gain. You purchase a property, a replacement property is $400,000, which is $100,000 less than the house you sold. So meaning you pocket that $100,000. So this $100,000 will be subject to capital gain tax, assuming there's no depreciation recapture. Now let's have a quick summary before we go into the form. So regular depreciation, if you sell a rental property, the regular depreciation you took before will be taxed as ordinary income, capped at 25%. So if excess depreciation you recapture, it will be ordinary income and yet up to 35%. Capital gain, if a period capital gain, then it's 0 to 20%. Depends on how high your taxable income is. Now let's take a look at this. Form 8824 is where you report the line kind exchange. So in part 1 is the information of the line kind exchange. Part 1 is basically the simple description. So the description of the house you sold, line 1, and the description of the house you receive. And then the date of the acquired house and the day you transfer the property to another to the buyer. And then with 45 days, which day you identify the property you're gonna purchase to replace the old one. And then also right here in the day that you actually close the deal. Okay. And also 1031 exchange cannot be among related party. So somebody talk about, oh, what about I have a property, my brother have a property, we do a 1031 exchange, I buy yours, you buy mine. So then we can both be happy family, we can exchange defer the gain. No, that doesn't work. Now on the second page, part 3, this is where the calculation come in. Like line 2 is the fair market value of other property you give up. So besides the house, you probably have other property inside or other value you give up, and what's the basis and calculate the basis, right? And then right here, number 14 is the recognize of other property you give up. Is like, let's say right here you have $200,000 you give up, and then how much cash you receive is a 0, right? 15 right here. Oh, fair market value like kind property you receive is $700,000. So you add this, that is the new property you get, and then the adjusted basis you give up on the property is $500,000. So let's say that is the property, and then the realized gain, which is 17 minus 18, you have a $200,000 right here. So you enter the smallest amount, and then on the 22, you subtract that the ordinary income from the recapture. We assume there's no recapture on this property, so the recognized gain will be 0. And then what is the deferred gain? Deferred gain will be $200,000. So the basis of a like-kind property received is going to be $500,000. So it's supposed to be $700,000. So because we did a 1031 exchange, and the old property right here is going to, the basis are going to carry forward. So the new property, even though you spend $700,000, so the basis is still $500,000. It's a quick correction right here. Line 14 right here is supposed to be 0, so that should be changed. Okay, so it's really quick recapture. So for a 1031 exchange is the 45-day and 180-day rule, and the capital gain tax rate from 0 to 20% if there is no depreciation. If there's a depreciation taken before the exchange, then there will be a depreciation recapture, and the tax rate, it depends on is a regular depreciation or excess depreciation. And the form to fill out is 8824, and the new property acquire, the basis of the new property will be the basis of the old property, and that's about it. So if you have any question, and can leave us a message, or please make sure you talk to your tax advisor, and they can help you figure out how to make this easier, the 1031 exchange easier. And let us know what else you want us to find out. Okay? All right. Thank you.